Stakeholders are defined into two, or rather they are categorized into two. They could either be internal or they could be external. And internal are those ones who have a day-to-day interaction with your business. So look at a stakeholder as, if it's in your family setting, you have your family, you have your nuclear family, and then besides that, there is the ecosystem in which your family exists. So you could be having a place where you go to shop, you could be having a place where you go to do your banking, who provides the insurance. So the two are operating in as much as it's in one ecosystem, they are both serving you, but your immediate family is more of internal to you, and then your external ecosystem is there to support you, but is not with you on a day-to-day. But the actions and the interactions that you have with them also affect how you operate and how you run your business. So having said that, we look at internal stakeholders. We've categorized them into, or rather we've gotten three of them. One is your employees, and by employees here we even include yourself. Remember, you're the founder of the business. Just as Simon has said, when you're now at the accumulation stage, you set the foundation, you've now gotten to the point where you are setting up the business. So you continue to be part and parcel of that business. By all intent, you still remain to be an employee of that business. Investors and shareholders are also others. What we have as investors and shareholders, what are their expectations? They expect the business in which you are operating to grow. They expect it to be, sometimes we set up businesses. There are those of us who will set a business to set up a legacy so that ijulikane hii biashara ni ya so and so. There are others who will set up a business just to cater for their expenses. I just want a business where I can draw my food, my expenses, pay for my kids' school fees, and move on. That's what I call my business. But in case you want, and then there are also the others who will set up a business so that they can sell it. But all in all, if you're an investor or a shareholder, if you're setting up a business, the bottom line is growth. I want my performance to continue growing day in, day out over the years, from 1 month to another. Now, if I'm just a shareholder, I will expect my return on investment to equally grow. So how do I manage that? How do I give, if those are the expectations of the shareholders? Remember now, even capital raising has become a very dynamic element in our business. So gone are the days when people are now looking for businesses in which they can invest and buy into. So if they are coming in as an investor, they need those two parameters. Now, how do I manage that as a business owner? I need to understand the investors or the shareholders that I'm having on board. What is their risk appetite? Are they risk averse, or are they the conservative people? How do I manage? Because you need to have a clear definition of who your stakeholders or your shareholders are to ensure that the risk appetite they are looking for is something that you can manage. It will be very unfair. Your business is just a startup, but the shareholders that you have or your investors are the ones who are at a growth stage. They are at a mature business stage. So they will expect so much from you, and that will create a friction because you want to manage growth pole pole, but then they want, within year one, they want you to have opened up branches left, right, and center. So understand the risk appetite of your investors and shareholders. You will find that we've got very many associations around the same place, but then just choose which ones which ones give the best value for money. Where do I feel engaged? Do I pay an association and then this association never gives us anything? Because I've also seen some of those associations. The associations themselves, they don't know what they should be doing. So they don't even have the capacity to mobilize what they should be doing. Then timely payment of subscription, membership subscriptions, that's what we talk about. Active participation is also important. But the most important thing that I have seen associations do is the economies of scale by virtue of leveraging. And maybe that's where you as an individual business, you may not be able to say that this tax is not favorable on us. But if you do it as an association, it becomes very empowering. Let me use something like the bank, whereby we have Kenya Bankers Association. A new law will be instituted by central bank, but then the bankers will now come through the association and say, so no bank will go on its own. They will come now as a body and say, hey, these new guidelines that you've offered, these prudential guidelines, they may be punitive on us. Will you slow down, or will you give us time to accommodate? If maybe a business wants, if it's something like what we experienced recently, the ban on scrap metal, it had to create an association which will now go and lobby to the government and say, hey guys, we understand there is all vandalism and so forth happening, but I think there's a way we can mitigate it in a different way other than banning the entire business, because there are livelihoods that will be affected. There are so and so businesses that will be lost simply because of the laws and the regulations that have been considered. So being part of an association therefore becomes your stakeholder. And just as the association has an expectation from you, you should also develop an expectation from your association. You say, yes, I am a member of this association. I joined you because of A, B, C, and D, but I feel as though my expectations are not being met. If they are not being met, and you have an obligation to participate. So running a business is not that easy, and at the same time, it's not that difficult. Then financial institutions. So this is where your banks and insurance company comes in. So what do they expect? What does your bank expect after they need to build a relationship? So they are going to give you loans. They are going to give you insurance. How do you manage that? Just as we have talked about that insurance product, how does it's in the interest of the bank that also you as a customer, you are moving forward with them as your business is in a position where it can continue sustaining itself. So how do you leverage on that? If you have a loan, how do you make sure that you're paying it on time? In case you have an obligation of maybe that's insurance premium, how can you be supported such that I don't neglect the whole point of insurance simply because of the magnitude, but maybe can I do it in a bit by bit basis, in profit, or rather in installments? So that's maybe an expectation. Adherence to laws and covenants. This is a very important part, because sometimes we are given offer letters maybe for a loan, but we never read in between the lines. There is something that we call loan covenants. And a loan covenant is simply telling you, for this loan to continue being sustained, you need to maintain certain ratios. So, and this is where now the business accounting comes in, because you need to be preparing to the bank on a monthly basis. Your management accounts could be monthly or quarterly or annually, but then they will be looking at your current ratio. And this is part of the bank, their expectation to manage credit risk, so that you just don't fall one day and then you're unable to service your loan. But they want, on a continuous basis, we can be able to see how is your business performing. We don't want to wait for all hell has broken loose. That's when you're realizing, kumbe this business was not profitable, it was not sustainable. We need to look at it. So when you're getting that offer letter, make sure that you understand what we call loan covenants, because they are included therein. Now, as a business owner, how do I manage this stakeholder called a financial institution? It could be having a robust accounting framework to ensure that you have proper and timely financial reporting. Your financial reporting is on time, is crucial. You also use the correct insurable value amounts. You may go and give a low insurable value amount so that you don't pay a high insurance premium. But remember, in case disaster strikes, you will only be compensated for what you had insured. Therefore, you will not get the true value. So that's why we are talking about getting the correct insurable value amount, understanding the expectations of each. And just as I've said in my earlier point on associations, just as you have the stakeholder has an expectation of you, you should also develop an expectation. You can go and tell the bank, hey guys, I think when I was opening this product, you had told me that after 3 or 6 months, I'm eligible for a facility. But right now it's 6 months down the line and I still haven't gotten a facility that I had wished in the first place. So you have that opportunity to, or rather that right, to go back and question what was set out to you as an expectation. Then, along with that, you need to consider engaging professionals on technical matters, such as reading and understanding the insurance contracts and the loan offer letters. I know there's a point where the laws have also changed, whereby a loan offer letter, even you as a customer, you have the right to turn it down within a duration of 30 days, so that it doesn't mean that because you've been given a loan of a letter, you have to take it as it is. There is that headroom for negotiation. A summary on how do we tips on good or rather effective stakeholder management. Most important, understand the stakeholders, both internal and external. Jiite yako kamkutano, know who are my stakeholders, who are my customers, who are my suppliers, who are my employees, and what are their expectations. Yeah. So understand everybody's expectations. It may not necessarily, you may imagine it, but it doesn't hurt to have that one-on-one with your stakeholders and know, what do you expect of me as a business owner? Do you expect, you may find something like your employee saying, I simply want appreciation for the work that I do. I simply want recognition, not even a salary increase, just that pat on the back, that thank you. It's a company, it's a business that came up with a very attractive, good project. Just a thank you note means a lot. So having done that, you also need to have an onboarding mechanism of various stakeholders. How do you bring in the stakeholders on board? If it is your supplier, do you have a pre-qualification mechanism? Do you say we only work with suppliers of a certain caliber, so that the stakeholders, you are working with people who have got expectations similar to yours? Then liquidity assessment for credit customers. Do you have a way in which you work? By the time you get somebody to credit, you'd rather salvage the relationship before getting into it than playing catch up later. So how do we assess? I'm going to give you credit of up to a certain amount or up to a certain threshold. Then having a conflict of interest form with your employees, so that nothing is, these are just some of the documentations that you could consider, so that nobody, you are trying to bring in the problem, you are trying to anticipate the problem and managing it early. So conflict of interest is one thing that can ruin your relationship. Maybe one of your employees is still your supplier. That one is going to be a messed up relationship. Then code of ethics as a business, anti-bribery policies, anti-money laundering policies. I know some of these may sound technical because they are kind of established businesses, but then how do you manage that relationship? How do you have those documentations to work with them? Then we have what we call the performance indicators. So when we talk about key performance indicators of the different stakeholders, if it is your suppliers, how do you work with turnaround time? Those are the KPIs that we work. How do you measure expectations? How do you measure reliability? Then over and above that, you need to monitor and evaluate KPIs on a regular basis. Have that round table, be it on a monthly, quarterly, or semi-annual, or even some of them annually. Come and sit down and say, how has the year been? Have your expectations been met? Have my expectations been adhered to and also met? That kind of thing. Then integrate financial reporting with other indices, or maybe on staff level engagement. So what is the relationship between our staff engagement and our business productivity? What is the number of staff that we are retaining? Are we losing out staff every now and then, every month? Those kind of things. Then staff satisfaction. Are our staff satisfied with our offering? And also customer retention. Why did a customer leave? What caused the departure? How can we go about managing it? Then last but not least, have what we call a grievance redress mechanism, a GRM, in business for both internal and external stakeholders.